Hello, Rossi Group. Ben Johnston here. I'm going to give a quick breakdown on the VA loan assumption, and there's a lot of moving parts to it, so if you have any follow-up questions, I'm happy to answer those. You can call me or just reply to the group text here. So a client that has a VA loan that wants to sell their property, we can market that as an assumable loan, and that loan that they have, we can assume it's at a low interest rate. It can be assumed by a veteran or a non-veteran, which is great. So, for example, if somebody has a house that they want to sell for $600,000, but their current loan is $500,000 of what they owe, the new buyer can assume that $500,000 loan, but they also have to bridge the gap to the purchase price. So what we can do is we can do a home equity line of credit to bridge the difference. So I've worked up an example of $600,000 home. So if they have a $600,000 house, a $500,000 loan, they can put 5% down on $600,000, which would be the purchase price, and they would assume the VA loan of $500,000, and then the difference would be in an equity line. So 5% down on $600,000 is $30,000. We can assume about $12,000 in closing costs. So that means the new buyer would have to come in with roughly $42,000 to purchase that home. Now, the example that we're working on now for Trisha's client in Dixon, their current rate is about 3%. So the interest rates on the home equity lines of credit are expensive. The rate is between 13 and 14%. But if you're not familiar with the home equity line of credit, your payments are based on interest only. So it's a very affordable way to borrow that amount to bridge the gap. So the benefit to the client is they get a blended rate. And what that means is we take the rate on the first mortgage, that's the assumed VA loan, and then we combine it with the equity line of credit. So let me just give you an example here. If somebody was doing a new VA loan today, the market rate is 6.5%. So in the case of this Dixon house, the first mortgage is at 3%, and the equity line would be at 13.875%, which gives them a blended rate of about 4.7%. So it's way better than the 6.5% that they would have today, and their payment's going to be much lower because they're assuming the low VA payment and then having the interest-only equity line payment. Excuse me. So that's a quick breakdown. I'll text the example of a $600,000 purchase price as well. And then additionally, the process of doing this is slightly complicated. So whoever is servicing the veteran's loan now, we need to call them and verify that they would be able to have a second mortgage behind that. So for the example in Dixon, the servicer is Lakeview Loan Servicing, and I already called yesterday and verified that they will allow that. So if we do one, or if we want to look at a scenario with a different company, we just need to call the servicer and verify that they'll do a second for the purchase, which I'm happy to do if we can get a mortgage statement from the client. So basically what we would do is I would take a full application from the prospective buyer and I would pre-approve them to make sure that they qualify for the equity line and the existing VA loan. So one thing to note is VA loans are very liberal in their underwriting guidelines, so they'll allow for a very high debt to income ratio. These equity line providers are more strict, so they'll only allow for a 45% debt to income ratio. So I need to pre-approve these people ahead of time to get them numbers and everything. Once they're pre-approved and they want to write an offer on the property, they can start the assumption process on the VA loan, but in order to underwrite the equity line and get it approved, we actually need a purchase contract. So I just need to be very careful up front to make sure that they're pre-approved for the amount before we get into contract and get the process going. So that's kind of the timeline of how things would happen. They would pre-approve with me. We would confirm with the servicer that they'll allow a second mortgage. We can start the assumption process, and then I would have the second mortgage underwritten, and we would close concurrently. So whenever the assumption's available to be done, that's when we would fund our HELOC, send the money to escrow, and they can close on the purchase. So I don't think I left anything out. Again, it's a more complicated situation, but right now we just have to be knowledgeable and creative to make these deals work, because as you know, it's a little bit tricky right now. So if you have any follow-up questions, please let me know. I am traveling. I'm in Arizona today and for the rest of the week. I'll be available for most of today by text, call, and email. And then tomorrow and Friday, I will have limited availability. So feel free to call or text. Hope you're having a great week so far, and I look forward to doing some of these deals with you guys. Have a great day.